Hi, everyone. Thank you for joining us for HerCapital's first virtual event in partnership with leading wealth management firm Aspiriant. If you're planning to post about the event, please use the hashtag HerCapitalXExperience and tag us. My name is Rabia Athar, and I'm one of the co-founders of HerCapital. I work in the public market space helping institutional clients invest their money.
Hi, everyone. I'm Zabreen Khan. I am also a co-founder of HerCapital. I work on the private market side at a growth equity firm investing in internet and software businesses. Having worked in the financial space for several years, Rabia and I received a ton of questions from our female peers on personal financial management and investing. Over time, we realized there was a real lack of resources and education when it came to helping women learn how to manage their own money.
Our anecdotal experiences are further substantiated by data. According to a survey by BlackRock, women keep 71% of their assets in cash, as a lot of us assume keeping money in cash is less risky than investing. We forget that cash that's left in savings actually depreciates in value over time due to inflation. Studies have also shown that women invest 40% less than men. Since women generally live longer and are often paid less than men, lagging in terms of investing further impacts female financial strength, leaving us significantly behind.
Historically, women have been less confident in their financial knowledge than men, but this isn't actually matched by worse financial decisions. In one study done by the German Comdirect Bank and the DAB on a sample of 500,000 private portfolios, women's portfolios did 4 to 6% better than men's on average. But for much of history, women have been left out of financial conversations. Now, as more women earn an income and build careers of their own, there is a high and increasing demand for more financial education and independence amongst women. Today, a third of the wealth in the world is controlled by women, and 92% of women want to learn more about financial planning. This is the exact reason why we built HerCapital. Our mission is to empower women to invest in their future. Through events, workshops, and an online knowledge base, we hope to teach, encourage, and motivate women to take control of their income, all while building a community of strong women who rise by lifting each other up. Given the current situation with COVID-19, and in an effort to extend our reach and help more women across the globe, we're so excited to bring our programming online. Before we get started here, we'd love to hear from you. Navigate to slido.com and type in the event code HerCapital. Feel free to do this on a second screen or on your cell phone so you can still view the presentation. We'll give everyone a couple of minutes to log into Slido. So we're seeing a lot of folks on the East Coast, folks from New York, Brooklyn. Rabia and I are actually based in New York. Yeah, a lot of New Yorkers here. And it looks like we're seeing some folks on the West Coast as well, Palo Alto, San Diego. Thank you all for joining us from across the country. And for those of you that are dialing in that are outside of the country, thank you for staying up or waking up early to attend live. As mentioned, we'll be giving a high-level overview on personal finance. This will include a section on retirement accounts that will be more US focused, but besides that, most of what we cover today should be applicable to everyone, no matter which part of the world you're joining from. For our kickoff virtual event series, we have partnered with Aspiriant, a leading wealth management firm based in California. Lorraine Fox and Lydia Waltz will be leading our discussion today. Both women are total rock stars and, of course, experts in the financial management space. This kickoff event is the first in a series of events we will be doing with Lorraine and Lydia. We'll provide a high-level overview on personal finance to help you get started on your journey today, and then our follow-up workshops will include deeper dives into some of the topics we cover. With that, I'll turn it over to Lorraine and Lydia to introduce themselves.
For that introduction, and moreover, thank you for creating HerCapital. We're here to help change the statistic and close the confidence gap that women feel when it comes to personal finance and investing. These topics are not taught in school. Unfortunately, we're all kind of left to discover them on our own. And we want to make sure that we can educate everyone who's attending and therefore empower everyone. I also want to introduce my colleague, Lydia Waltz, and she will give you a little bit about her background.
Thank you, Zabrina and Rabia, for having us here today. I have worked with Lorraine at Aspiriant now for 2 years. I've been in the industry for 4 years, and it's been a big surprise to most of my friends and family, as I was a humanities major at Bryn Mawr and generally abhorred anything to do with math or economics while I was there. But I think that goes to show that anyone can learn how to manage their finances and participate in investments. So I'll take us into a conversation about the two sides of money. You know, a lot of what's going to be in this conversation today is going to be about the technical sides of money, so the accounts, the investments, and taxes. But it's really important to keep in mind that this is mostly an emotional topic. Money can be the representation of our personal financial goals and how we strive to achieve them. And it can be a heavy conversation to have, and one that I don't think our society has enough. So growing up in our lives and from our peers, we'll probably have heard different money messages. And so perhaps they were, you know, money can't buy happiness and time is money, but, you know, there are other happy considerations that people have with money as well. So I'm interested to sort of hear what you heard growing up and have the conversation there. Rabia and Zabrina, you can come in with some of the answers that are happening here if you'd like to share them. But in the meantime, I think that we can also move on and talk about this great quote that I've heard recently. I think it's an older quote, but it was by Cher. She said that her mother had told her, "Sweetheart, settle down and marry a rich man." And I said, "Mom, I am a rich man." And I think that is just a great quote because it has shown in some ways how far we as women have come. But you know, what Zabrina and Rabia were saying in their introduction about how women do get left out of some of the growth in finances, it's very true, and all the more reason why Lorraine and I are so passionate about financial literacy. So today we'll start by understanding the 5 main pillars of financial planning. The first step in any good financial plan is goal setting. So this one is really by far the most important and one to take a lot of time with. You know, it's exceptionally hard to execute the rest of the financial planning steps without having goals to work for, something to achieve. So then the second element is budgeting and cash flow, understanding the bottom lines and sort of getting the rhythm of the cash flow. The knowledge is going to be power here. Once you have a handle on this, you can start saving and investing, which is the third pillar. These are the 3 pillars we're going to cover today. The other 2 are insurance and estate planning, equally important. And definitely good to have in the worst case scenario. Not something we're going to cover today, but if there's interest, we can certainly discuss it in a later section. So now we'll get into some of the technical about how to understand your cash flow and start saving and investing the money left over after you've covered your spending. So chances are you've heard about some of these savings and investment accounts. I'm curious to hear from you what you've heard about, and you know, what do you know about so far? It would be great just to understand where you're at.
It looks like a lot of folks are saying usually they think about checking or savings accounts, 401ks, IRAs. That's great because we will actually be going into more detail about 401ks and IRAs shortly. But it seems like those are typically what people think of. And then of course we have brokerage accounts as well, which Lorraine will be touching on towards the end.
Fantastic. That's wonderful. So I think we should address first, before we're getting into the savings accounts, how to construct the savings. So that would start with the budget. So you want to understand, you know, what's the money that's coming in? That's the first step. Just take stock. What's the net into your bank account, either from your job or from wherever you get your money. The next step is to understand the data that you have for your spending. So what is the essential need to keep a roof over your head, to keep yourself fed, the utilities on, your loved ones cared for? That's going to be a really critical number to have a firm understanding of, because that's going to influence a lot of the savings that happen next. So then the third step is for the delta that's in there. So what's left over after you subtract your necessary expenses? You're going to subtract your savings. So you're going to take out some savings that you can put aside. Now start small. Make sure that it's comfortable. You don't want to over save and have to knock down some of that savings and take out of it later. So you know, start small. Just even 1% would be good of your paycheck. And then after that, you have the number that is your discretionary spending or further savings. So the fourth step would be to understand, you know, what are you left with that can be used for, you know, that thing that's going to make you happy this month. And perhaps what makes you happy this month is further savings. It's completely up to your discretion. So what do you do with, I'd also say that there are apps that can really help you with understanding how you're spending. So Mint is a common one. There's YNAB, You Need a Budget. And a lot of these apps will connect to your credit cards or your bank accounts and can help sort your spending categories so that you understand, again, the budget is not so much about fitting yourself into prescribed numbers. Rather, it's understanding what's going in and what's going out and harnessing that knowledge. So in the next section, we're going to explore some common accounts. But before we get into those accounts, I think a word on taxes. If you made less than $12,000 as a single person, you do not have to file a tax return. However, you can if you like, and under some circumstances, it can be beneficial to do so. When you file your taxes, the amount that you report to the IRS is called your adjusted gross income, or AGI. This is the amount that the IRS is going to consider on your tax bill. The AGI can be made up of both passive income, so proceeds from an investment account, dividends and income, and active or earned income, so that's proceeds from working at a job. So bringing this back to the accounts that you can save in, there are 4 common types. First, we're going to cover taxable. So that's going to be your bank accounts and your brokerage accounts. And so you have said already that you're familiar with the bank account. This is a checking account and a savings account. And then the brokerage accounts are any kind of non-retirement or non-earmarked taxable account. So what do I mean by that? The funds that you put in there have been considered in your adjusted gross income for the year. And you either have already paid taxes on them through withholdings from your paycheck, or you will pay taxes on that money come tax time. Then if there's any gain made from the investments in the brokerage account, or any interest accrued from the bank account, that you also report to the IRS as part of that adjusted gross income. That's the passive income we discussed. So next is the tax deferred account. This category is mainly made up of retirement accounts. There are 2 here. This is the IRA, or the individual retirement account, and the 401k. When you contribute to these tax deferred accounts, you don't report what you put in there, your contribution to the IRS for your AGI. Said differently, it's not counted in your tax bill for the year. So depending on how much you end up putting in, you could potentially lower your tax bill for the year. Then the next piece is the after-tax account. And so this is also a IRA, a 401k, and a 529. But let's cover the IRA and the 401k first. So it's largely comprised of retirement accounts. The common word to describe this account, these after-tax retirement accounts, is called a Roth account. You may have heard of that. You can have a Roth 401k or a Roth IRA. What happens here is that unlike the tax-deferred account, you do include what you put into those accounts in your adjusted gross income for the year, meaning you'll pay tax on what goes in. However, you don't ever have to pay taxes on it again. So if you put your contribution that you've already paid taxes on in there, it can be invested and it can grow. And when it comes time for you to take it out, you don't have to pay the capital gains from the growth of the investment. That's a powerful tool. The other after-tax account in there that's listed is a 529 account. This is mainly for education savings. So just like the after-tax retirement account, you can put the money in after having paid taxes on it, and then it can grow. And when you use it specifically for an education-related cost, you don't have to pay taxes on any of the investment income from that. The main difference from the retirement account is that it's earmarked for education and you can access it before you turn 60. And we'll get into some of the retirement account details then later. But finally, we have the tax-free account, which is the health savings account. This is kind of a special hybrid. So you can lower the contribution that you put in there is not taxed. It's not considered in that adjusted gross income for the year, so that you get the write-off benefit there. But then you also, if you use it for a medical expense, don't have to pay taxes when taking it out, just like the 529 or the Roth accounts. So if you use it specifically for co-pays at the doctor's, prescription drugs, there's a list on the IRS website of qualified expenses. You could potentially just never pay taxes on that money. So let's take a deeper dive into the retirement accounts. The tax-deferred retirement account will come first. As we covered, there are two main ones, the IRA and the 401k. So for the IRA, who sets this up? Again, go back to the name. It's an individual retirement account. So you go ahead and you set it up and you make that account and you make your contribution to it. For the 401k, your employer at the beginning of your job will ask you whether or not you want to participate in it. They'll ask you how much do you want to put into it. And so they'll help facilitate that, but you have to make the selections. So in an IRA, the maximum contribution you're allowed to make in 2020 is $6,000. Now, I mentioned before that you don't have to file a tax return if you made under $12,000, but there could be benefits. A big benefit here is that if you made under $12,000, perhaps you even made under $6,000, you have what's called earned income. And you're allowed to contribute to your IRA up to the amount of that earned income. So if I made $5,000, I could contribute to this IRA account $5,000. I have a new maximum. So rather than that $6,000 that's written there, you can only contribute as much as you made. So that's an important asterisk. So for a 401k, you're allowed to contribute $19,500. These again are maximums. Do what you can, but keep in mind that there are caps on how much you can contribute in 1 year. If you're over 50, you get a catch-up amount, so you can add on $1,000 to your IRA contribution. So you could potentially contribute $7,000 as long as you made over that amount, and the same for the 401k. Now, here's the big point of the tax-deferred retirement account. You deferred those taxes when you put it in. So you got to lower your tax bracket potentially, or you got to write off the amount that you put into that account at the front end. You must take a required minimum distribution at the age of 72. And a tax-deferred retirement account. So this is the IRS is going to ask you to distribute a certain amount, and it doesn't mean you have to spend that amount, but it does have to come out and you do have to be taxed on it at ordinary income rates. This can be a bit of a drawback if you didn't really want to pay a lot of taxes in retirement. It's completely based on the size of your account though. So if it's not a very large account, you might not have to distribute as much, but there is that drawback there. Finally, the investment choices. So for an IRA, you are usually, it's unlimited. You opened up that account. Remember, you have the wide world of investment choices at your feet. In a 401k, you might be restricted to a menu because remember, the employer opened up that account for you. They might feel that there could be some liability on their side for if you make a wild investment choice. So they might limit you to a couple of selections. Now, switching over to the Roth, so the after-tax retirement accounts, I'll just draw your eye to the fourth line here in bold. Most things are exactly the same as the tax deferred aside from the distribution point. So in a Roth IRA, you do not ever need to take a required minimum distribution. Remember, you paid those taxes up front, you never are taxed on it again. An important asterisk to this is under the Roth 401k section. You would be required to take a minimum distribution if you do not roll that Roth 401k over into your Roth IRA. Just when you move on from a job, make sure that you're keeping tabs on your different 401ks and that you are understanding the implications of doing that. So in the next slide, we'll see that there are some considerations to take into account with retirement accounts. So first of all, for the 401k, most employers will match some level of employee contribution. Not all of them, they're not required to, but it is a great practice that if your employer does do a match on your contribution, so for instance, say they contribute, if you contribute $2,000 to your 401k, they'll contribute $1,000. Make sure that you're doing that full $2,000 to get that $1,000 match. That's an extra $1,000 that you're entitled to. It's part of your compensation. So try at least to get that. And then, as I was saying before, you may roll your 401k from a former employer into an IRA at no tax cost. An important consideration here is that you are keeping your types close. So if you have a Roth 401k, you want to roll it into a Roth IRA. If you have a traditional or tax-deferred 401k, you move it into a rollover or a traditional tax-deferred IRA. So then the fourth point here is at your discretion. If you might want to convert some of those pre-tax dollars, the tax-deferred accounts in your IRA, and make it into Roth IRA money, you're allowed to do that. You can convert it and just pay the taxes, but do keep in mind that that will mean a tax bill for you this year. All right, and with that, I will hand it over to Lorraine, who's going to talk to you a bit about personal investing.
All right, I hope just to review where we started with your how to create a budget, how to allocate your money between your current financial needs and your future financial needs, retirement and other investment accounts. And in order to talk about one of the principles of personal finance, the first thing we want to talk about is compound interest. So Einstein has this great quote: compound interest is the eighth wonder of the world. She who understands it earns it. She who doesn't pays it. That's a really important point throughout all of investing. And one of the implications is the earlier you start investing, the longer your money and investments can experience compound interest, and the more you'll have at the end of a time period. So we have a great example to show you, and this is 4 different people, 4 different scenarios, but each of them invests $10,000 a year, and that can be in your 401k, for instance. But the important thing is what happens if you start at age 25 and you invest consistently every year for 40 years till age 65, which is the traditional retirement age. How much money compounds and accumulates, especially at a high growth rate of over 6.5%. So that person is Chloe, and she will end up with, and this is an astounding amount considering you're starting with $10,000 a year, you end up with almost $1.9 million at age 65. That's a lot of money to help fund your retirement. I know retirement seems so far away, but it's really important to start planning for your retirement as early as possible. Age 25 is what we really recommend if possible. Then we have our next person, Quincy. So he also invests, and he starts at age 25, but he only invests for 10 years. So he stops investing at age 35. He still earns 6.5%. Now, if he just leaves that money in there to compound and grow, he'll end up with a pretty good amount, but it'll be less than half of what Chloe has. But he'll still end up with $950,000, roughly. Then our third person, Lila, doesn't start investing at age 25. She waits until she's 35. She invests for 30 years, but she's going to end up with even less money, and she's still going to have the same investment rate of 6.5%. So she ends up with about $920,000 for 30 years of investing just because she waited 10 years to start investing. That's a huge impact. And then finally, Noah starts investing and saving when he's 25. And he invests also all the way up to age 65, but he has a much lower investment rate, the rate of inflation roughly, at 2.25%. So he's going to meet inflation, but he's only going to end up with $652,000. So the moral of the story is start investing early, stay invested. Look, even if you can't contribute $10,000 every year, even if it's $5, it's better than zero. Just keep on investing, keep on experiencing compound interest, keep letting your investments grow over a very, very long period of time, and you'll end up doing very, very well. So also in terms of, so you start investing at age 25, you keep on investing for the next 40 years. Then the next question I bet you're going to ask is, well, how do I invest? And there's one other lesson that we want to leave you with today, and that's diversification. So we've heard a lot about the importance of diversity in life, in business, and the same is true when you invest. Don't put all your eggs in one basket. Diversity of thought is important, and diversity of investments are also important, because no asset class can win in every single environment. This is what we call a checkerboard slide. I know it's very busy, but the most important thing that you can take away from this slide is that one category of investments doesn't win year after year after year. So below, we've categorized these different kinds of equities or stocks. US large cap, those are like the 500 largest stocks in the S&P 500 in the United States. So companies like Amazon, companies even like Nike, Lululemon, those are all examples of US large cap stocks. Then you have US small cap stocks. Those have a smaller, and the cap stands for capitalization. So that means the number of shares outstanding in that company times that stock price is somewhere between 300 million and 2 billion in total. So an example of a US small cap stock would be Sonos. If any of you are familiar with that audio company, that's considered a small cap stock. Then we have international large cap stocks. Those again are very large companies that are headquartered outside of the US, in Europe, Australia, or Japan. So Nestle would be a great example of an international large cap company, and probably we've all consumed some Nestle's products like their chocolate. Then we have international small cap, and we have emerging markets. And when we talk about emerging markets, we talk about the BRIC companies primarily. And what that means is China, India, Russia, and Brazil, or all of Latin America. So you're talking about continents that aren't part of developed economies in Europe, Japan, or Australia. So you're talking about Asia, you're talking about Latin America, you're talking about India, and you're talking about Eastern Europe. There's a whole other category of assets called frontier markets, which includes Africa, and those didn't even make it on the chart. But the main thing is you can see that in some years, say emerging markets will do really well, and then they'll do really poorly. So you want to have some combination of all of these in your portfolio. You want to diversify. The next thing we're going to talk about is, again, that the US does not always lead. So again, you can't put all your eggs. It's not advisable to put all of your eggs in the US basket. If you look at the decade from 2000 to 2009, the S&P 500 was flat. So if you had had all of your 401k invested in the S&P 500, you wouldn't have made any money for 10 whole years. If you had diversified across all those different kinds of asset classes, emerging markets, international, small cap, medium cap, and even bonds, you would have had a much better performing portfolio. So again, the main takeaway is diversification across different kinds of stocks. And then again, to go back to our first point about investing early and remaining invested, you really make more money the longer you are invested in the market. Some people will become afraid when they see the stock market go down and they want to take their money out or convert to or sell everything and go to cash. Then the question becomes, okay, when do I get back in again? And by staying out of the market, you really end up losing out on accumulating wealth. So this chart will show you, if you stayed fully invested over a period of time, you would end up with the most money. If you missed the 10 best days, that almost cuts the amount of money that you have in half. And the numbers go down from there based on how many days you are out of the market. So stay in the market. I know it takes discipline. You can't let your emotions override the reality. So now let's talk about, we've given you a few investment principles now, and let's talk about what kind of accounts you can open at what kind of institutions. So there's 3 basic common service offerings. For accounts, you have a broker-dealer. That's a very transactional oriented account. So Wells Fargo, Bank of America, Goldman Sachs, Morgan Stanley, JP Morgan, those are all broker dealers. You open up an account. The brokers are compensated based on fees and commissions, and that's it. It's just transactional. Then you have an advisory firm such as Aspiriant, which is not based on transactions. It's based on giving advice, and holistic advice at that. So it not only advises you on investments, it works with you on your financial plan, it works with you on your estate plan, and it works with you on about your taxes to create something that's going to work for you over a long period of time and help you meet your financial goals. The third is a newer offering, and it's called a robo-advisor. So examples of a robo-advisor are Betterment, Wealthfront, Schwab Intelligent Advisor. And what happens here is you go online, you open up an account, they ask you a few questions on your risk tolerance, and then an algorithm automatically takes your money and invests it in a diversified manner. And that's how it operates. So it's very automated. You know, there's very little human interaction involved, and but it is very low cost. So finally, I think I wanted to sum everything up and say, we've told you how to budget. We've told you how to divide your money into shorter term and longer term retirement. We've given you a few principles on investing and diversification. We told you how to open up accounts. And now it's time for your questions and answers.
Thank you so much, Lorraine. That was terrific. I know that was a ton of information that we just threw at you guys. You know, this event will be recorded. You can always come back to it to re-listen, and engage with the content. We'd also encourage you to follow us on our social platforms, as we do distill a lot of this down into more bite-sized pieces. And I think the more we engage with this type of content, the more it'll stick with us. So as Lorraine mentioned, we'd now like to move into our Q&A section. We'll start with a few questions that were submitted earlier via our online channels. If you have any live questions, feel free to submit them via the live chat function here on YouTube. So let's kick things off with an important question that was submitted by one of our community members. It's difficult to know where to start in building financial security. Do you pay off debts first, save for retirement? How do you know where to start and where your energy is best spent?
That's a great question. I think a good rule of thumb is to work on paying off debts first. And when I say debts, I'm meaning more specifically credit card debt. That can be very high interest rate debt, and it can really eat into your cash flow. It can also hurt your credit score under certain circumstances. But I would also say that this is a bit of a balancing act. So you want to pay off that credit card debt, but you also want to make sure that you're saving for your emergency fund. So that is going to be 3 to 6 months of those essential expenses that we discussed in your budgeting. So it's a bit of it's again, a balancing act, but make sure that you're working on that credit card debt. But should that income source stop that's helping to pay down your debts, you really don't want to need to swipe that card any more than necessary in order to cover your basic needs. So having that emergency reserve is going to be your life raft in those situations.
Wonderful. Thank you, Lydia. And Lydia's advice is, of course, applicable, no matter what is happening in the world. But we do realize we're in a very strange time where a lot of us have been affected by COVID-19. So we'd love to get your advice on how to react to the pandemic. Do you have any tips on how women should iterate on their financial plans during COVID-19?
Yes, let me take that question. So the first thing is, if you have been impacted by COVID-19, the first thing we want you to do is take care of yourselves first and foremost. If that means you have to modify how much is going into your 401k or a brokerage account, make sure you have enough money to take care of yourself, and make sure that you're availing yourselves of some of the programs, governmental programs that have started to assist people during these times. Number one, you may be entitled, and by the way, we'll have a link to a blog post with very detailed information. I'm just going to give you the highlights now, and then you can refer specifically to this blog post called Fathom that we put out. But the first thing is, you may be entitled to a recovery rebate from the government. There's some income limits. And so I encourage you, and you may have received a check already, but I encourage you to look at our article and see what the income limits are and whether you qualify or not. The second one that I think is going to be important for a lot of people, you get some breaks on student loans. So you'll be able to suspend payments and accruals of interest for federal student loans until September 30th of this year. That's really big. So you don't have to pay your student loan. You won't have interest accrue for a good portion of this year. And then finally, there are expanded unemployment insurance benefits. You have to file through your state, and specifically the state where you were employed, in order to get these benefits. But please take advantage of those, because those programs the government has provided both on the state and federal level to help people through this really unfortunate time.
Amazing. Thank you, Lorraine. And as Lorraine mentioned, we will be sending a follow-up email with additional resources. It will include a link to the blog post that Lorraine mentioned that covers the CARE Act, along with additional resources that you guys should look through with more information on this topic. The next question is for some of our younger audience members. Any advice for recent college grads who are thinking about building credit and paying off loans?
Absolutely. So building credit, you can't start too soon. So let's start first with how to build some credit. You might already have student loans. That's great. Pay those on time. I mean, it's not great that you have to have the loans, but it's great for your credit score because that means that you've already started building that credit. If you don't have student loans, you might consider, or even if you do, you might consider opening up a starter credit card. So some words about credit scores first. You start and you have usually, it takes 5, 6, 7 years sometimes to start getting past the beginner phase. When you start, so there are 3 main credit companies that help formulate your overall score. They're called Equifax, Aspiriant, and TransUnion. And a credit card or a student loan will formulate a statement at the end of each month and send it with your information on what you've paid and if you paid it, how much you paid off, if you met your minimums. It'll send that off to those credit agencies and they'll work on formulating that score. For a credit card, it makes a lot of sense to just, to the degree possible, have that statement that's sent to them have a $0 bill number on there. So just don't have any outstanding liability at the end of the month. The other consideration to take into account with credit cards is the credit line that you are given. So when you got that credit card and you started that history with that credit, you were probably given a credit line. Let's say it was $1,000. Really try hard not to spend more than $500 on that card. Don't use more than 50% of that credit line. In fact, try not to use even 10% of it. But I understand a lot of the times it's helping you make ends meet. But again, keep in mind that the credit line is not your new budget. You know your budget, you collected that data, stick to your budget. And also, when you start your first credit card, it makes sense to do a credit card that doesn't have an annual fee associated with it, mainly because you don't really want to shut that card down. That's going to be the card that started your history, right? So you want to have that line open for a very long time, even once you start adding on to your credit for things like mortgages and loans, auto loans, more credit cards. These are the things that are going to come together to compile a history for you. And you want that history to be long and you want it to be of on-time payments. Having a credit score is going to be really helpful for you in later goals, perhaps like qualifying for a mortgage or being able to get a rental apartment. They run your credit score. Another consideration here is that you don't want to apply to too many cards at once. You don't want to apply to too many loans at once because they do what's called a hard pull on your credit, which is basically where the company who you applied for the loan will call up TransUnion, Equifax, Aspiriant, and say, can I have that credit? And that's called a hard pull. And you really don't want too many of those in a short amount of time. Having a few is fine, but you really want to space them out because having too many can actually impact your score. For finding cards to start the credit line, I really like NerdWallet. They do a pretty good job of synthesizing good data on which credit cards to have. In terms of student loans, again, keep in mind it's never ideal to start off with loans, but it is a really great thing for building your credit score. So to the degree that you are paying it off and being on time, that's really phenomenal. And like Lorraine said, make sure to take advantage of any kind of pauses that you can take, especially in this harder time when you don't have to pay the interest on it, perhaps until September.
Yeah, and just to reiterate what Lydia said, starting early is so important. You know, both Lydia and Lorraine have emphasized that in all of their answers today, as well as, you know, earlier during our presentation. So start early when you are investing, start early when you are saving for retirement, start early in building your credit. There's no such thing as starting too early. So whether you are 18, whether you are 22, the best time really is right now. And I think that's a really important piece of advice. Another question we have with regards to women planning for the future, how can we better prepare ourselves to buy a home?
I will take this one as well. So a consideration that you want to have, first of all, in purchasing a home, the way that many people do it is that they do the research on where they want to live. What's the market like there? So what kind of home do you want and how much does that cost? This is one of your financial goals. Set that goal, understand the data around it. The next step is going to be to understand, how are you going to finance it? For many, people get mortgages to help them afford homes. In order to qualify for a mortgage, you usually need a pretty good credit score. Try to get in something over 600, ideally in the 700 range. And then from there, you're going to also need to save for what's called the down payment. So that's going to be usually 20% to 30% of the cost of the home that you want. Most banks will write you mortgage loans for 70 to 80% of the value of the home. So if you are 3 to 5 years out from that goal right now, you might consider saving your down payment in something that's not terribly volatile. So maybe investing it wouldn't be the best idea. You might want to keep that in a bank account that maybe pays a little bit of interest. But if you have a longer runway on this goal, and you want to get some help with that savings, you might open up a brokerage account and start saving in there, because then you get some of the capital gain that might be associated with better investment results. But remember, that will be subject to volatility. So you'll want to make sure that your risk tolerance on that is acceptable to you.
Awesome. Thank you, Lydia. And just looking here at some of our live questions, we'd love to take one of these. What are some of the better high yield savings accounts?
I'm happy to speak to that as well, unless Lorraine, you have a particular.
Oh, go ahead.
Okay, so there's a large list of them. I will just say, as an overall statement right now, given the state of our economy, interest rates are really low. You might have seen news that the Fed dropped rates. That might have been the title that you saw. Basically, the bank accounts aren't paying a ton of interest at the moment, but some good high yield savings accounts are usually the ones that aren't brick and mortar banks. So Ally is an online savings account. Wealthfront, I think, has an online savings account. There's many, and again, I would refer you to a NerdWallet. They usually do a pretty good job of telling you where the good interest rates are at right now. The idea here is that these banks don't have sites where you go into the actual bank, and as a result, they save on the rent and the overhead that's associated with that. And in a lot of ways, they're actually just able to pay that back to the bank account owner through a higher interest rate. So usually online banks are going to be your best bet.
Awesome. Thank you, Lydia. I think that's all the questions we have time for today. If we didn't get to your question, we will make note of it and we'll try to address it in one of the follow-up workshops within this series. Finally, a huge thank you to Lorraine and Lydia for joining us and sharing your wisdom. This was incredibly helpful to us and to our audience, and we're so excited to continue this series with you. A special shout out to our programming team, Katie, Ava, and Elizabeth, for helping make this event come to life. We couldn't have done it without you.
Thank you, Zabreen, and thank you, Lorraine and Lydia. We hope you found today's discussion helpful and are leaving with the realization that no matter what your background, financial knowledge is attainable and extremely important. We hope that we can work together to bridge the female investing gap. Before we conclude, here is a list of our social media platforms for you to follow along. Also, please subscribe to our YouTube channel so you can remain up to date with additional programming. As Zabreen mentioned, stay tuned for our follow-up email containing more resources on how to better manage your money. We will also be sending out a survey in that follow-up email so you can continue to tailor future events to better suit your needs. We will schedule follow-up events to this series with Lorraine and Lydia and would love to hear from you on any specific topics you'd like us to cover. As Zabreen mentioned, we've taken note of all the questions that you sent online on our various platforms, and we'll be sure to try and dig deeper into some of those in the coming up sessions. Finally, our next virtual event will be an investing panel on July 15th. You can sign up through our website. Thank you everyone for joining and for supporting HerCapital. Take care and have a great rest of your day.